Okay, so let us see now. MAT has got a couple of amendments. 3 of them are important, and yeah, maybe they can test you in this area. So let us see what is this importance. Now we are discussing MAT amendments. So you all are familiar that basic standards in that MAT we add and subtract those adjustments and list, you are familiar. Now we will only stress on the new things which got added. So what got added? This is the P&L account of a company, and in here they have said that they've got share of income from AOP. Okay, so let's say it is around 10, and interest on borrowing in order to invest in the AOP they have spent about 2 as interest on borrowing, and the net profit is around 100, subject to the other calculations. I'm just giving you an extract. Okay, so now a company is doing some joint venture in the form of an AOP with other companies and executing some project. This is their status. So we know that in MAT, if you observe, there is one item, okay, which says you need to reduce and you need to add. What do we reduce? That income which is exempt under section 10 and its related expenditure. When you're reducing exempt income under section 10, obviously its related expenditure needs to be added back. Related expenditure needs to be added back. Okay, this is the general rule, needs to be added back. Now in this list, what can come? In this list 1034 can come. Okay, what is that? Dividend from a domestic company. 1035 mutual fund can come. 10 subsection 1 can come. 10(2)(a) can come. What is this? Share of income from a partnership firm. Yeah, but all this is coming in this list. But this list is clearly telling us that do not give this adjustment when it is 1038. No. Okay, and do not give this adjustment when it is 10AA. No. Okay, 1038 and 10AA, what are these? These are long-term capital gain exempt, and this one is SEZ unit, export of software, they are exempt. But this MAT adjustment is telling for these two MAT is attracted. You have to put MAT on it. You may be exempt under the normal rule, but when it comes to MAT, we will not give you any benefit. But other things, we will give you benefit. So indirectly, it means agricultural income, it is exempt even for general provisions as well as for MAT provisions. Now in this list, if you observe, this list is starting with the series called 10. Okay, and it is giving us this exemption. But see now, to our surprise, Budget 2015 has realized there is some other list which is not in 10 but exempt. What about those items? For example, what are we discussing? See, an AOP which is covered under the provisions of 167B. Okay, there are some special provisions for AOP 167B. Whether it is subsection 1 or it is 2. Okay, here what happens whether share is known or unknown. Basically this section is planning to tax the AOP at MMR or at a higher rate or a combination of both. Higher rate higher than MMR in case if the member is a foreign company will pay tax at 40%. So we are planning to tax this AOP at these rates. Because the AOP is already suffering huge taxes, the members of that AOP are exempt under section 86. Okay, members of AOP are exempt under 86. The reason being AOP is already taxed. This point is not coming in the list of 10. Because it is not coming in the list of 10, what is happening prior to this budget? Prior to this budget, we were simply not doing any adjustment. So if you look at this, these data prior to budget and post budget, same P&L account. Prior to budget, what we did, we have taken MAT on this amount. Net profit is, I said 100, and there are no adjustments. Adjustments for 86 concept was not there. Book profit became same 100. But now post amendment, what has happened? Net profit is 100. The lawmakers are saying because this share of AOP is exempt under section 86, we don't want to put MAT on it. So less share of AOP, because it is exempt, we will remove from here 10. And its related expenditures already debited, and expenditure on this 2. So what is the impact?
88.
Yeah, 90? 10 minus 2 is 8, yeah. 100, no? 92, yes. So see now, after the amendment, what happened to book profit? It has come down to 92. On this we are planning to take 18.5. So this is the implication. So you finish learning one adjustment in math now. What is that adjustment? Share of AOP is exempt in the hands of members under section 86. Therefore, it needs to be reduced. Okay, reduced. Why reduced? It is already credited to P&L account. Therefore, it needs to be reduced, and its related expenditure needs to be added back. You finish writing one line. Okay, share of AOP is exempt under section 86. Share of AOP is exempt under section 86. Therefore, it shall be reduced for computation of book profit. It shall be reduced for computation of book profit. It shall be reduced for computation of book profit. Done? Okay. Coming to the next amendment. Amendment number 2. They may test you, so just be careful. The second amendment is also important. So what happened now? Sometime back I was telling you this list. That whenever this is the income, MAT is not attracted even on this. MAT is not attracted on 1034, 35, 1 and 2A. And here I said on 1038 MAT is attracted. This has an exception, that is foreign company. Okay, foreign company is an exception to this concept. Foreign company is an exception to this concept. What do you mean by that? How do we read? Generally, MAT is attracted on 1038, but if it is a foreign company, MAT is not attracted on 1038. What could be the reason?
We want to encourage.
Yes, we want to attract foreign investments. So imagine if you tell them 1038 exemption is there, and another way you say we have MAT for you 18.5% on it. How will they react? So it's not correct. So we need to say that 1038 is subject to MAT. However, it is a foreign company, then MAT is not attracted on that. So there is some clarification regarding this. Budget 2015 is helping us understand the situation. So how they are helping us understand? Let us look at it with an example. Things will make it easy for us. So this is the P&L account of which company? The next adjustment, please put the heading. We are discussing for whom? Foreign company. So let's say if you are sleeping and you forgot the heading and you end up doing this adjustment for a domestic company, gone then. Okay, all your effort of learning is gone. So whom are we addressing? A foreign company. Okay, so foreign company is got royalty. Okay, royalty. Just observe the example of 30, and they have short-term capital gain 111A, which is 40, and they have long-term capital gain 1038, which is coming to 50, and they have long-term capital gain under these special series 115 AB, AC, AD, offshore funds, foreign institutional investments, all that is 20, and any other long-term capital gain which is on listed shares, but STT not paid, is not paid, and that is 10. Okay, that is 10. And corresponding to this, expenditure on royalty, everything makes sense with an example, Theory will not help until and unless you personally see the numbers. STT on what? On 111A. Expenditure on 111A 2. Then expenditure on LTCG 1038 is 3. And then you have expenditure on LTCG, which is 115AB, which is 4. And STT on which shares sold outside stock exchange is 1, and net profit is coming to 132. Okay, this is the P&L account. So many adjustments we have to discuss. That's why in my this thing I have put everything. So now if you observe, this is a foreign company. Carefully watch what happened to this foreign company. Now this is an amendment by budget 2015. Prior to this, this was not there. So if you observe, royalty for a foreign company is 115A. okay, which says we will take tax from you at 10%. And it clearly says that it is flat 10%, we will not allow any expenditure deduction for you. No expenses are allowed on the gross amount, we want 10% from you. Then 111A, resident or non-resident, it is 15%. 1038 is exempt, Then 115AB is long-term capital gain at 10%. Okay, that section is telling foreign institutional investments, offshore funds, ACAD, whatever you want you can put. And this is LTCT on listed shares but STT not paid. Okay, when it is not paid, it is listed security. We know there is a proviso to section 112 which says option 1 or option 2, whichever is better. And we know this is a foreign company, so investment might have been done in foreign currency. So without taking the benefits of 48 proviso 1, 48 proviso 2, straight away we can tax this at 10%. So normal route is this. This is the normal route. Now imagine if this amendment was not there. If this amendment was not there, we would have simply taken 132 and we would have applied 18.5% on it. So which is unfair. The foreign companies are reacting and they are saying one place you are attracting us with these special sections, at another place you put MAT on us and you put 18.5, not fair. So 132 would have suffered 18.5 as MAT. So to take care of that situation, one amendment has come. Can you draft a line what should be the amendment?
Or we should be reduced.
Yeah, in computation of book profit. Yeah, in computation of book profit, we have a net profit of 132. What to do? What to do? Remove all these incomes. Now what is the name of these incomes? Let us name them capital gain on securities, royalty, interest income. What is special about these incomes? You have to specify that also. They are in normal provisions. They are getting taxed at smaller rates. What do you mean by smaller rates? Royalty 10% or 1038 is exempt, or interest, if you observe those sections are there, interest on infrastructure debt fund is only 5%. So normal rates for these are less than 18.5. In that circumstances, it is not fair to put 18.5 on it. So what shall we do? In computation of book profit, remove all this. Okay, remove it off from here. Don't put 18.5. Okay, and when we are removing it off from here, what to do with the expenditure? All the related expenditure needs to be added back. That is the adjustment. So imagine if we have to compute these with these numbers, you know, we are kind of revising your non-residents also along with MAT. So let's say if we want to do computation, how do we do it? Total income, just 5 minutes and our revision will be done under regular income tax route. Okay, if you see the breakup, this royalty as it is will be going to PGBP chapter, okay, 30, and it will be taxed at under section 115, we are putting 10% on it, so that is 3. Okay, then how did I simply pick up royalty? See here, we want income from business or profession. P&L account has got a profit of 132. All these belong to which chapter? Capital gain. So from 132, if I remove off everything, what will I get? 30. So my income from profession is 30. So therefore I am saying income from profession, regular income tax I am computing is income from profession is 30. Under 115A I will put 10% on it and I will take ITL is coming to 3 lakhs. Okay, this is my income tax liability under regular route. Now coming to capital gains, I know 111A is at 15%. 15% of 40. Okay, of 40. 40 is the size of the capital gain. This is coming to 6. And then LTCG, which is exempt under 1038, again that is coming to around nothing, no ITL on it. And then LTCG, which is 115AB, that section is telling that you have to put at the rate of 10%, that is coming to 2. And then LTCG, which is proviso to section 112. There are without indexation. I am not taking indexation benefit, no indexation, I am putting 10%, it's coming to 1. Okay, this is all coming to 12 lakhs and I will add education 6. Okay, so now this is the scenario about my regular income tax. Now prior to amendment and post amendment. Prior to amendment there was no such adjustment. Then what I would do, net profit 132, adjustments nil, adjustments are nil, and book profit is 132, and I would have simply taken 18.5% of 132, which is a very higher amount. But now post-amendment, net profit is 132, remove, less, all capital gains which would have suffered a smaller rate of tax, 150, add back all related expenditure on it. So if you keep on summing up, it is coming to 18. Just observe, so book profit became nil because of these adjustments, so therefore no MAT. Okay, this is the conclusion. And this 18, how we got, just observe, 10 and then 7 and 8, 18, everything corrected. So this is the analysis. Done, everyone? So what is that one line that you need to remember? We have done the regular income tax computation in this manner. We should zoom in, I think. Yeah, this is the regular income tax computation, and for book profit purpose, we are reducing the entire 150 because it is suffering smaller rates when compared to 18.5, and its related expenditure we are adding back. Impact is there is no book profit, there is no MAT. Okay, this is the conclusion. Done, everyone? So basically we don't want to take 18.5 from a foreign company when it is investing in India in terms of capital gains, 111, 10, 38, etc. Okay. The next amendment is in terms of your business trust. Okay. So when we are discussing business trust, that time we will come back and understand, because now if we discuss again it will become difficult for you. Okay, so leave some space. Let us first do business trust and then come back and put its MAT related adjustment entries here. One little small half a page space you can leave, or 1 page space you leave better. Because without business trust, if you are understanding its related entries, it will not make sense. Okay, now we are discussing another important topic, and I am expecting, because previous attempts there were questions from business trust, because that was a new topic for your seniors. This year there is an amendment on business trust. They may give a question or they may not give, we do not know, but this is a very new topic. Okay, they may give question from here, so just be careful. What is that we are discussing? Alternative investment fund. We are discussing a topic called investment funds, alternative investment funds. Okay, what happened is basically in this topic, what happened, let us understand. Okay, earlier funds were divided into two types. Okay, they were simply calling it anything which is venture capital fund and other fund. Okay, other fund. Venture capital fund was enjoying pass-through status, whereas other funds no pass-through status. Okay, normal tax provisions would apply. Normal tax provisions would apply. Okay, now you will ask me, what do you mean by other funds? See, basically there are so many funds. They are called category 1 funds, category 2 funds and category 3 funds. Basically, some examples are small medium enterprise related funds, private equity funds, social funds. To encourage different kinds of setups, we have different types of funds. But when you want to call it venture capital fund, you need to satisfy these SEBI guidelines. So many restrictions and conditions are there. Whereas these other social funds, investment funds are not subject to so many guidelines when compared to venture capital fund. But whether this fund or this fund, both are helping the country at large to become socially strong and economically strong. But this venture capital fund was enjoying pass-through status. What do you mean by pass-through status? The fund, whatever income it is earning, it will not be taxed, it will enjoy exemption because it is only acting like a medium or a facilitator. It is taking and it is passing through. So who will have to pay tax on it? The investors have to pay tax on it. But the other funds were not enjoying this pass-through status. When we say no pass-through status, are they happy? This is the question. They are not happy. Why? What is the reason? This other fund could have been an AOP, or it could be a trust, or it could be a body corporate. So imagine if it is an AOP or a trust or a body corporate. AOP, we know it gets taxed at MMR 30%. Body corporate companies are also getting taxed at 30%. So if you observe, the entire income getting taxed in the funds at the rate of 30% is not favorable at all. Whereas here the venture capital fund is enjoying exemption and the money is passed on to the investors, was happening. But this was not fair at all. So these people were requesting, we are also contributing to the country, then how can you be so partial to us? Why are you not giving us pass-through status? So what the budget did, the budget said, okay, don't cry. What we'll do, this chapter 12F was there. Now we will remove this, and 115U is there, we will remove it off. Instead of this, we will now say it is chapter 12FB. See, the name got FB. Okay, and instead of 115U, we will say UB. These are the new sections that have come for you. Okay, and now students are under misconception that for venture capital fund, we will apply the previous section, and for the other funds, we will apply this section. No, the answer is no. This is totally omitted and it has been replaced with chapter 12FB and 115UB. Okay, this is important, you have to remember. Okay, so now, what are the tax implications? Before we start, just start writing because I am sure you will get a question from here. So we will put some effort to write down. No, not on the mat. For mat, leave one page because we need to understand business trust to come and understand that adjustment. How many of you in this class are aware with business trust? I had discussed at ICA and I discussed here also. No, that was gone. Huh? I know you all have been overburdened with so much of study, so obviously you listen that minute, but you forget. That's human nature, yeah. 80% of what you read today, you forget tomorrow, right? And where is the time for you to revise? You all are so busy with so many subjects. All classes done, ISCA is also done finally at ICA. You're not going to ICA, but every day I see you there only. Yeah? Because the more you come out, the less time you get to study. Chalo, let's not worry. So now we are discussing the tax implications. So put a heading, tax implications for the fund. Because we have to solve one question to understand this topic, tax implications for the fund. 5 minutes, writing will help us. PGBP income is taxable in the hands of the fund. By PGBP income we mean the fund is charging some commission fee etc. for running the activity. So whatever fee they collect from the investors or alternative income by investing money, surplus money somewhere, that kind of income is belonging to them. So that they have to pay tax on it. But next line, any other income which is invested, which is earned, right, or any other income which is earned through investment on behalf of the investors is exempt in the hands of the fund, under section 1023 FBA. So how do you write it? 10 in brackets 23 FBA. Be careful. Okay, 1023 FBA. At least the amendments we will remember the section numbers. I don't know the rest of it what you're going to do, but amendment related topics, don't forget the section numbers. Okay, next line. Loss. Next point, loss in brackets not PGBP, shall remain with the investment fund. Okay, so see what are we discussing here? In case the fund has incurred loss by investing money, okay, that loss should not be passed on to the investors. Rather, it should be held by the fund. What will they do by holding it? They have to carry forward. Why they are stopping the loss from getting spread? The reason is what? Control purpose. See, the fund will file return of loss. Based on the return of loss, we can carry forward and set off benefits to the fund. Imagine that loss if you distribute among thousands of people, then that control over the loss is missed. So to avoid that, we are saying loss, you don't spread it, you keep it with you. Okay, shall remain with the investment fund. Next point. The fund should deduct TDS. At the rate of 10%, the fund should deduct TDS at the rate of 10% under section 194 LBB. Under section 194 LBB. Next point, investment fund should define return of income. Next heading you put, this was for the fund. Okay, now for the investor, write down for the investor. PGPP income is exempt. PGPP income is exempt. Why? The fund is paying tax on it. How can we once again tax them, and it is now not given to them in fact. Pass-through income is taxable proportionately. Pass-through income is taxable proportionately. Okay. See, whatever you heard now will make sense if you understand. Let us take the example of a venture capital fund. There's an investor, resident or non-resident. What is this person doing? It is investing money in venture capital company or venture capital fund. Okay, and how does it invest? By subscribing to the units or securities which are under private equity scheme. And this venture capital fund could be a company, it could be a trust, it could be a body corporate, AOP, whatever name you want, but it should be registered with SEBI. And this one is rather investing money in venture capital undertaking. Okay, by either subscribing to equity or to the debt. And this venture capital undertaking is basically an unlisted company. So I told you these days startup is the theme. Everybody is coming up with startup companies. Okay, so in startup concept, the idea has value. In future, the idea may make a lot of money. So there are some private equity investors who are watching that idea. They are liking the idea and they are ready to give money. So basically this venture capital undertaking is an unlisted company. They have some good project with them, and these investors are rich people, high net worth people. They have created a fund. Through this special purpose vehicle, they are investing money in this venture capital undertaking. Then what are we saying to this fund? We are saying good news for them. Under section 1023 FBA, should not forget, they enjoy exemption. What kind of income we are giving exemption for them? Income from venture capital undertaking. For investing money in this venture capital undertaking, by subscribing to equity, you get dividend. By subscribing to the debt debentures, you get interest. And tomorrow, if you are selling off your securities, you get capital gains. All this is exempt for the fund. Okay. What is not exempt? Other income. Not exempt. So imagine if this special purpose vehicle is collecting some fee for doing all this activity, that is not exempt for them, that is taxable for them based on the normal rates. This is the story for the fund. Now what about the investor? The investor, whatever it is getting, okay, it is taxable. For the investor, income received from the fund is taxable. And which section is telling us this? The new one we just said, 115 UB. So you should not forget this section, exemption section, and this one. In what proportion? As if funds are directly invested by the person. It is taxable as if funds are directly invested by the person. So what do you mean by this? So let us say venture capital undertaking has given to the venture capital fund the following money. Okay. So let us say venture capital undertaking has given to the venture capital fund, and venture capital fund gave it to investor. How much they gave? 20 lakhs. How much they gave to them? 2 lakhs. This is the breakup. 20 came from here and 2 is given to them. What is the breakup of this 20 lakhs? There is some dividend in it, 8, There is some interest in it 4. There is some short-term capital gain in it 3. There is some long-term capital gain in it 5. 20. Observe now. See, what issue are we discussing? Venture capital undertaking passed on an income of 20 lakhs to the venture capital fund, which has got to break up dividend, interest, short-term capital gain, long-term capital gain. Out of this 20, we gave off 2 to the investor, and we are planning to tax the investor. So now the issue is, what is the name of the 2 lakhs? What are we going to call it? Are we going to call it income from other source, or are we going to call it capital gain? What is the name? What did we write? As if the funds are directly invested. As if the funds are directly invested. So they are saying the same proportion will apply on 2 lakhs. So now in this case, for you 80,000 is dividend, then 40,000 is short-term interest. This is dividend, this is interest, and then short-term capital gain is 30,000, short-term capital gain. Long-term capital gain is 50,000. This is the breakup for you. So by giving this name of 2 lakhs, what are we planning to do? This dividend of 80 lakhs will be exempt under 1034. Domestic company will pay DDT on it. In the hands of the person, it is exempt. Interest income will go to IFOS. Capital gains, normal or triple money is not possible because this is all unlisted company. Triple money is not possible. Normal STCG, LTCG will get taxed at 20%. Like that, we are going to learn now. Okay, breakup is in this manner. Okay, now what kind of income is this? This is one important note you need to remember. This is income after adjusting losses, if any. If this one has incurred some losses, they need to adjust those losses and give it to them. So it is after set off of losses. But however, if some additional loss is left, even after set off, if something is left, carry forward benefit is only with the fund but not the person. There is a small question on it. Quickly finish it off. Come to your handout. See the question, important, that's why I am doing it slow. Somehow you get that strong feeling, no, this will come in the exam, that feeling we have. 19th page. 19th page. Prithviraj just help us with this one. This zoom in, you ensure that at least the page is visible, this little size. This entire page is also not coming. There you go and do the adjustment. Through the remote you try. Full page should come every time. Because of the camera. Sure? No, they have done zoom out, zoom in, something they did. You want me to disturb this?
1 second.
Okay, it is with the camera to be adjusted, huh? Okay, fine, fine. Okay, now fine. Now, this is better. No, camera is fine now. I think there we have to do. No, sir. This should be fine. Leave it. Okay. Done, everyone's finished doing the question. What were you busy watching? Finish this question. Your time is very important. I'm scared for you. Oh, it has become cross, I think, no? Not audible. I have to increase. Yeah. So see the question. So what is the answer for this? if you observe, there are 3 funds given in this problem, and they have given us information for next year for us to just apply what topic, carry forward, set off and all. That they want us to check on this. So let us see what is this question. So what we will do, there are 3 funds A, B and C. So if you observe, we know only business income needs to be taxed in the hands of the fund, and business income is only with B. Whereas there is a loss of 2 in the hands of fund C, which we will go for carry forward. Okay, so this is nil, this is 2 and this is nil, and we will write when it comes to fund C, -2 will be carried forward. Now coming to what is the implication in the hands of unit holder. Okay, this was for the fund. Now we will discuss for the unit holder. For the unit holder, what are we going to do? We will say it is receiving money from 3 types of funds. So see, observe, capital gains it is receiving, and each person how much they have received, you have to calculate accordingly. Each investment fund has got 20 unit holders, each having 1 unit. So you need to calculate for 20 unit holders. So in this case, capital gain will be coming for 20 people is coming to 80,000, and IFOS is coming to 4 is 20,000. Okay, coming to the next one. Yeah. The next one is got business income, which we already taxed, whereas 14 is 70,000 it is coming, and the next one is 20,000. Coming to the next one, see, observe, when it comes to carry forward benefit can be taken by the fund, but set off you need to do before you give money to the investors. So here there is -6 and there is +8. So we know that we have to apply the provisions accordingly. See, business income can be set off with income from other source, but yes, then we have to be careful here. Capital gains cannot be adjusted with other sources. So what is left is only income from other source. You should be getting 30,000 here. Did you get 30,000, everybody?
Yes.
Yeah. Now coming to next year, they have given us some information about next year. There's a business income of 2 lakhs. There's a capital gain of 9 and income from other sources 8. So next year what will happen? Now see, this business loss already got adjusted. What is left over is capital loss from last year. So next year business income remains 2. There is capital gain after loss adjustment. 9 minus 6 is 3, and IFOS is coming to 8 lakhs. 8 lakhs. So in this case, business income of 2 lakhs will be taxed in the hands of the fund. Fund will pay tax on it, whereas capital gain and income from other source will be taxable in the hands of the unit holder. So capital gain taxable in the hands of unit holder will be 15,000, and IFOS taxable in the hands of unit holder will be 40,000. Done, everyone? So by 20 we are doing, so we are getting these numbers. So in the same proportion, that is what we learned, in the same proportion. Okay, now business trust, again I am putting it on hold because some of them want to leave. So if they are already familiar with business trust, they can leave, then we will come back and do later. But very important topic, those who do not know should stay back, learn and go. Those who know can leave us and go. Okay, so we finished now these topics. We will now pick up the other issues and finish. There are so many potential questions from exam point of view. One by one we will finish. Investment fund, everybody knows. Alternative investment fund. Yeah. Which chapter we finished? Chapter 12. FP. What is the name? Which section? 115. UB. What is the section for the fund? Which section it is exempt? 1023. Okay. Chalo, good. So now we are just finishing off the miscellaneous topics. So TDS again, if you observe, I have been telling you that 11 topics are very important from exam point of view, and one among them is TDS. You don't like it, you postpone till the end, but one question every attempt is sure to come from here. TDS is so important even at CA final level. Okay, so what do we know about TDS? What are the amendments? Let us check one by one. So we are saying 192A, page number 23 we are discussing 192A. Okay, 192A is telling TDS is to be deducted at the rate of 10% if amount paid out of Provident Fund scheme, PF scheme, is rupees is greater than 30,000. So you should never forget these two things. And before you understand 192A, I would like to remind you about the provision. Which provision? This has become cross, no? The visibility is cross. Because we are recording, that's why I'm asking. 3 to 4 hours of class it is, so we should not compromise. That's why I'm asking. It is not cross, it is okay? I should put the book like this then. Okay, fine. Yeah, so when is Provident Fund getting taxed? Any idea? Statutory Provident Fund, triple E. Recognized Provident Fund, triple E, subject to. Of course, this budget has changed the story. Yeah.
They are willing to accept it and postpone it.
Okay. So this is subject to conditions. Subject to conditions. I am not discussing PPF here because here we are discussing from employer point of view. So in PPF, employer is not involved. You unrecognized Provident Fund, EET. Okay, this is the scheme. So now RPF, when we are writing triple E subject to conditions, what does this mean? If you remember, there was a condition there. If the person is withdrawing money after rendering 5 continuous years of services, then we can give him exemption. However, this had some relaxations. If you shift employment from one company to another company and you carry forward your amount, you don't withdraw, then it is as good as it is continuous service. And there was one more relaxation. If a person is dying before 5 years, we cannot tax him because death is not in your hands. So basically, RPF is exempt if you are keeping the money for more than 5 years and then withdrawing. But let's say somebody is withdrawing before 5 years, then we are going to tax him, and when we are taxing him, it is subject to TDS at the rate of 10%. However, there is a limit. The amount is up to 30,000. No need to put TDS. Only when it is more than 30,000, it is subject to TDS. Next amendment is unrecognized Provident Fund. We know very well because the taxman doesn't want to encourage URPF. He is following triple EET route. And in fact, this one, if you observe, when you are contributing money, under ATC you don't get any benefit. ATC is not available for contribution. Then what is this employer contribution for you is exempt as of now. Tomorrow when you withdraw, it is taxable. Interest on that URPF is exempt. Future withdrawals are taxable. So under this scenario, this section 192A has come. Okay, just be careful. Now coming to the next one, 194A. You know this section very well. It is TDS on what income? Interest. Interest. What are the amendments which have come here? One, misuse they have taken care. What is the misuse that people were doing? We know very well, no? When Mr. A is got a huge amount, 10 lakhs, what he would do? He will go to different branch 1, branch 2, branch 3. Branch 4 and create small FDs. With what in his mind? He is keeping in mind from each FD, from each branch, the amount of interest should be less than 10,000. Because if it is less than 10,000, I need not pay tax on it. There is no TDS on it. So now there is an amendment which has come which says, if these banks are following core banking solution CBS after so many years, CBS launched in 2006. From 2006 to 2015, they allowed this misuse to happen. Now they realized and they said, if the branches are under core banking solution CBS, then in that case, we need to do aggregate of all branches. And is it possible to know? See, here we are not saying banks. I am not saying Andhra Bank, SBI and ICICI you sum up. I am saying with SBI, whatever branches you have FD, sum up all the amount. Yes, on the system you can find out. Not a big deal. Just by putting the account number, you can know how many accounts, where, which branch he's got, what is the aggregate that he's got, everything you can find out. So aggregate of all branches, if it is more than 10,000, then TDS is attracted at the rate of 10%. This was one clarification which has come. So no more misuse, it is based on core banking solutions. Done? Further, saying that this 194A has got some more amendments. What is that some more amendments? Earlier there were some relaxations in this section. What were the relaxations? Relaxation number 1. When the bank was giving interest on fixed deposit, we bifurcated this into 2. Okay. FDs are of 2 types, recurring deposits and normal fixed deposit. On recurring deposit there was no TDS, and on this there was TDS, but now budget 2015 is telling here as well as here both we want TDS, whether it is recurring deposit or any other fixed deposit, time deposit, whatever name you call, we need TDS on it. Okay, obviously lawyer, the limit is going to take care. If the interest is more than 10,000, you need to pay TDS on it. What is the nature of deposit is not a big deal. This was one thing. Second thing is, now there is a cooperative bank. Okay, this cooperative bank is paying interest to its members who are the deposit holders. To its members who are the deposit holders. So we are saying, earlier this interest was not subject to TDS. Now even on this TDS is attracted. So earlier we were under the same fiction. What is that? The group and the members are one and the same. So that kind of fiction we were living in. But now we are saying these members, instead of going outside, they are creating a deposit with a cooperative bank. Even on that interest, TDS is attracted under this section. Okay, next one. A person is receiving interest under a dispute, motor accident claim tribunal, Okay, so prior to this amendment, this interest was subject to TDS on the basis of credit or receipt, whichever is earlier. Credit or receipt, whichever is earlier. Now you think practically. Let's say litigation is on and they passed a judgment in favor of the victim saying that yes, so much amount compensation has to be paid to you. But the party who has to pay the compensation need not oblige immediately. The person may not pay immediately. That time on the basis of credit, if he is subject to TDS, it is not fair. So now the amendment is saying that interest from motor accident tribunal is subject to TDS on what basis? On receipt basis. Only when you receive it is subject to TDS. If you don't receive, it is not subject to TDS. Okay, what is the next amendment in this? Yeah, the rest you can just run through. The next one is 194C. This is important from exam here, just be careful. 194C. Every time this transport fellows, they keep playing. No? TDS relaxations for transporters. You have observed. Every time something or the other they come up with. Now what is the latest amendment that we are saying? Who is the transporter? Point number 1. The good news is this transporter can be an individual, it could be a HUF, it could be a partnership firm, it could be a company. Point number 2. The goods carriage vehicle, big size, small size, whatever might be the size, anytime during the year, is number of goods carriage vehicle anytime during the year is less than or equal to 10 vehicles. Then good news. What is the good news? There is no TDS for you. Provided you give a declaration, you sign and give that the number of vehicles with you are less than 10 and you give your PAN card. If you give us these 2 things, there is no TDS for you. Okay, done everyone? Okay, just check the color if it is too light. Too lighter? Black is better? Okay. So there is no TDS if there is a declaration and PAN card. See the questions here. These questions will help us understand. They might give one from here, one item from here. Just observe. X Limited is a fertilizer manufacturing company located in Telangana. During the year, it makes the following payments. Rupees 6,20,000 to A Limited. A Limited owns 25 goods carriages during the year. Okay. Now to answer, first of all you should say, madam, this is post-budget. Please tell us the story pre-budget. Then we can answer. Because post-budget is effective from 1st to June 2015. Okay, these amendments are effective from 1st to June 2015. Then what about pre-budget? Pre-budget, okay, last month financial year, they are saying that any transporter, when you were doing your IPCC, it was not like this. It was same 10 goods carriage vehicle. But previously, last year and up to June, any transporter, irrespective of number of vehicles, how many vehicles you have, we don't know, there is no TDS for you. You just give your PAN card information, nobody will deduct TDS for you. A kind of, this lorry business, truck business, lot of political lobbying is involved here, basically. Okay, so that's why this provision was there. Any transporter, company or a non-company, irrespective of number of vehicles, 10 or 20, there is no TDS for you. All you need to do is give your PAN card information. That company which is having transaction with you will take your PAN card, inform the IT department. IT department will cross-check if they need, but as of now, there is no TDS for you. This was pre-budget scenario. In this scenario, now see, now students will get tempted to read. This fellow has got 25 vehicles, so I think we should put TDS on him. See, concept of 10 vehicles condition from when did it come? From 1st to June. Prior to 1st to June, what was the story? Any transporter, any number of vehicles, there is no TDS for you. So what is the answer right there? It is first, means what? Prior to budget. Yeah, you write there, no TDS, irrespective of number of vehicles. No TDS irrespective of number of vehicles. Amendment is applicable only from 1st June 2015. So even though this person has got 25 vehicles, still we are not putting any TDS on him. No TDS on him. Next one. 11 lakh something, partnership firm, okay, consisting of so many people, owns 9 goods carriages on April 1st. It purchases 5 goods carriages on 1st November. And then it owns, partner B owns 40 goods carriages in his sole proprietary capacity. See now again, see the magic is here. We want 10 vehicles anytime during the year. Means what? How the law is drafted. Out of 365 days, 1 day, if you have less than 10, it is enough. 364 days, you have 100 vehicles also, we don't mind. That is the provision. Very bad it is. Yes, that's the intention of the lawmakers. Then why did they write any time during the year? Actually, the law should have been small transporters. We don't want to put TDS on you. And the meaning of small transporter is at any time during the year, your number of vehicles shouldn't have been more than 10. But that's not the language of the law. See the law's language. Read it again. See the first line. It owns 10 or less than 10 goods carriages at any time during the previous year. That means even for 1 day if they had less than 10, it is enough for them to enjoy this, no TDS. Here we didn't write throughout the previous year. So these are the questions from your ICA book, so don't worry, we didn't misprint it, that is the law. So write the answer there. Okay, write the answer. As on 1st April, the number of vehicles are less than 10. As on 1st April, the number of vehicles are less than 10. Therefore, there is no need of TDS. Next question. See 5,92C. C is not in the business of plying of goods carriages up to April 10. Business of carriages started by purchasing 50 goods carriages. See the interpretation now. You know how to interpret this question. We should learn interpretation skills now. See, they are saying out of 365 days, first 10 days, how many vehicles he's got? 0. Balance number of days, okay, 355 days. How many vehicles he's got? 50. What is the law telling? Even for one day, if you have less than 10, 0 means what? Less than 10. There is no TDS for you.
But this is before starting.
Yes, an interpretation says even before starting the business. Nobody is asking you for your business.
No.
See the point here, let us read it again. Here when we say owns 10 or less than 10 goods carriages anytime during the previous year is even before starting the business of flying the vehicles. Unfortunately, the law is like that. That's all. It's not logical, just to make them happy. I told you political reasons are involved behind how to keep them happy. This is a huge vote bank, yeah? So that's why the provisions are like this. Don't search for logic. Not needed.
It says 9 goods carriages on April 1st. That is pre-budget.
Yes, pre-budget. And the provision doesn't say post-budget you should have less than 10 vehicles. From 1st to June onwards, to put TDS on you or not, we are checking any time during the year, did you have less than 10? So from 1st to June onwards, if it was less than any time during the year, no TDS. Prior to 1st June, whether you have 100 vehicles, that's why to understand this, look at this point here. A company which is into transport business has got 50,000 vehicles running across the country. What is the answer? Nobody should deduct TDS for them. When you're not reacting for this, then why you're troubling these small fellows? 1 day, 2 days, they may have less than 10 vehicles. It's okay, no? Here then what should have been a reaction prior to budget? What was your reaction prior to budget? How can you give like this? How people have thousands of vehicles, how can you say no TDS? But that was not the reaction, there was no TDS irrespective of number of vehicles. Now they came up with one condition, any time during the year, if you have less than 10, no TDS for you. So to appreciate this, look at this, then you can understand. Right? Both are in the interest of transporters, pre and post budget. Yeah, with some conditions here. Chalo, see the next one. Fourth question. 8,45,000 to D. D Limited is in the business of carriage of goods and passengers. Previous one we didn't answer. There was no TDS, no? Yeah, there was no TDS we have said. Okay, this one. D Limited is in the business of carriage of goods and passengers. On April 1st, it owns 11 vehicles. It transfers 2 of them on November 10 and purchases 5 new on 12th November. Now you have to check on 10th November how many vehicles they had. 9. Less than 10. Again, good news. No TDS. No TDS. Capital gain is different here. As of now, we are discussing TDS. Chalo, see the next one. Besides X Limited, next one, fifth one, pays 2,30,000 to E Limited on Jan 10. The payment pertains to transportation of employees of X Limited in the city of Hyderabad. Entire story applies only when it is goods carriages and not human beings. Okay, so now transport of passengers is subject to TDS irrespective of number of vehicles. This condition that you're reading is only for goods carriages. Okay, so here the payment pertains to transportation of employees. E Limited does not own more than 10 buses during the financial year. So passenger buses could be more than 10 or it could be less than 10. No problem. TDS, here you write TDS is applicable. TDS is applicable. TDS is applicable. Beneficial provisions are only for goods carriages. Beneficial provisions are only for goods carriage. Beneficial provisions are only for goods carriage. Okay, now see the next one. Out of these next ones, some of them you can, yes. And further, there is another question on 194A. Just look at the next page, finish answering it. On 1st October, Mr. Harish made a 6 months FD of 10 lakhs at 9% with ABC Cooperative Bank. The fixed deposit matures on 31st March. Okay, so for 6 months, how much is the interest coming? 45. Is it more than 10,000? Yes. Is it subject to TDS? Yes. So write that TDS is attracted. TDS is attracted as the amount of interest is more than 10,000. No amendment, simple it is. They are just testing whether you know the knowledge. Cooperative bank is also subject to TDS. Next one. On 1st June, Mr. Ganesh made 3 9-month FD of rupees 1 lakh each, carrying 9% with Dwarka branch, Janakpuri branch, Rohini branch of XYZ bank. So irrespective of the number of branches, we need to aggregate and find out. So you sum up everything. So fixed deposit matures on 20th February. So 1 lakh into 3 branches into 9%. Okay, 1 lakh. But you see the date. When did we put the money? 1st June. So how many months it is? 9 months. So 1 lakh into 3 branches into 9 by 12 you need to check. Or deposit matures on February, no? 20th February, no? So March you should not be taking. So from June to Feb you should take. From 1st June to 20th February. How many months it is coming? 9 months everyone? Okay, for 9 months is the interest more than 10,000 for the 3 branches? Yes. So TDS is attracted. Last question. On 1st April, Mr. Rajesh started a 1-year recurring deposit of 20,000 per month. So it is a recurring deposit. Per month he is depositing 20,000. Yeah, so earlier we said that on recurring deposit there is no TDS, but now recurring deposit every month means, see, he started on 1st April. From 1st April to 31st March if you observe, 20,000 per month into 8% for full year. It is going to recur for the entire year. So how much it is coming? Per month. So 20,000 into 12 months into 8%. This is the size of the interest. Okay. How much is the interest? 19,000. Is it more than 10? Yes. So therefore it is subject to TDS. Earlier, why recurring deposit was not subject to TDS here? What was the nature? Try to understand. Recurring deposit means every month you're going to keep putting 20,000. But if you check for the entire year, 20,000 into 12 months, a huge deposit, earning a huge interest. So from this year onwards, they're saying, don't just look at per month calculation you don't do. If you do per month calculation, 20,000 into 8% for 1 year by 12 if you do, it is a small interest, less than 10. But we are not going to do per month calculation, do it per annum and see. If it is more than 10,000, then it is subject to TDS. So this is how recurring deposit is subject to TDS from this year onwards. Okay, done everyone? Next to 2 things. What is that we are learning? Just see the reference. 194I. The business trust has invested into real estate projects. And these real estate projects are let out, and when it is let out, rent is earned. So now 194I is telling to the tenant here, all of you observe here what is the theme that I am discussing. There is a business trust, means one organization with lot of money. What did they do? They went and purchased one commercial complex, a shopping mall, a multiplex. They bought it, and once they bought it, they are not selling it, they are giving it on rent. So business trust has got real estate projects, buildings which are let out and it is earning rent. There is a tenant here and this business trust is the owner. So normally section 194I, what does it say? If the rent paid is more than 1,80,000, then TDS is attracted. But now this business trust, we will be learning little later, enjoys pass-through status. Because it enjoys pass-through status, this tenant should not deduct TDS. Okay, then who will pay tax on it? When business trust is passing on the income to the investor, from the investor we are going to take tax. But as of now, the tenant should not deduct any TDS from the rent which is paid to business trust. So what is one line now? Whenever a tenant is paying rent to a business trust, what is the nature of this business trust? It enjoys pass-through status, because of which the rent earned is exempt in the hands of business trust. It will be taxed in the hands of investor. So it does not make sense. If you deduct TDS, it doesn't make sense. So 194I is telling don't deduct TDS. The next 2 sections we will learn when we are discussing business trust. 194 LBA. is applicable for business trust, and one more we will learn, which is 194 LBP. Sometime back we referred, but I think we didn't write the section number. This is applicable for alternative investment fund. 194 LBP, alternative investment fund. Okay, now that we have discussed alternative investment fund, tell me what is this section 194 LBP? Alternative investment fund. Take the example of venture capital. What did we say to venture capital fund? You are exempt. The income is taxable in the hands of investor. And what did we say? You should deduct TDS. So now which section you will deduct TDS? 194 LBP. Every alternative investment fund which is passing on income to its investors has to deduct TDS under this section called 194 LBP. And what is the rate at which they have to deduct? See, just come to the bottom of the page number 26. Is there any rate? Just give a reading. Any income other than that proportion of income which is of the same nature as referred under 1023 FBB, okay, is payable to a unit holder in respect of units of an investment fund. The person responsible for making such payment at the time of credit or payment, whichever is earlier, should deduct income tax at the rate of 10%. Okay, now you observe, when we were discussing the example, that 2 lakhs that we gave to the investor, what was the nature of the 2 lakhs? Some amount was dividend, some amount was interest, some amount was short-term capital gain, long-term capital gain. The nature of the income is varying, but when it comes to TDS, it is not asking us for the nature. It is only telling whatever you give, 2 lakhs you are giving, on that entire 2 lakhs, please deduct TDS at the rate of 10%, irrespective of the nature. This you need to remember. So breakup of the income is not required now. For TDS purpose, breakup is not required, but the person has to file his return. That time he should know what is the breakup of that income. He will take a credit of this TDS, 10% whatever he is paying, he will take a credit for that. Okay, then what else? This 194 LD is not that important. 195.6 we will discuss in penalties this point. Okay, some of them we are picking up and reading. Okay, then what are we discussing now? Let us check. 197A. Just one small addition has come. 197A. What is this topic? Self-declaration. Self-declaration in form 15G, 15H for no TDS. Do you remember this point?
Yes.
Yeah, we know, we see our parents and grandparents going to the bank and saying, they submit this 15G, 15H saying that our income is less than B and please don't deduct TDS. So there is a scope. Actually 197A is telling you give a self-declaration under this form for no TDS. This section got extended. Okay, they are applying this section in addition to the previous sections. It was applicable for interest income. In addition to that, now they are saying it is applicable for 194DA, and today we learned one section 192A. This is your provident fund and this is your, recollect yesterday, insurance budget 2014 had added this point. That's why we didn't discuss this section, but it is equally an important and new section. Last year it got added, 194DA. What was that? 194DA? All these insurance companies are paying LIC policies to the person, either on maturity or to his family on the death. Huge amount they are paying. And we know that all LIC policies are not exempt under 1010D. If you remember, IFOS, there are certain restrictions are there. Keyman is not exempt, and it is not exempt if the premium paid is more than 10% of sum assured. Those limitations are there. Keeping that in mind, they came up with this 194DA, which is telling all insurance companies, whatever policies which are not exempt, you please start deducting TDS. From last year, this section has come. However, we are giving a relaxation under 197A. The person can give a self-declaration for no TDS. So not a big deal to read this. Coming to 200. 200 also you need not read. Then what about this 200A? Okay, 200A we have to read it. What is 200A? Small story, 5 minutes. What is this 200A? Processing or assessment of TDS returns. Okay, the deductor is submitting TDS return. We need to assess that. That assessment is done under 200A. So the officer who's doing the assessment, he will check for arithmetical errors. He will check if there is some wrong rate is wrong, or he will check if the claim is wrong, incorrect claim. All that he will check. Okay, when he is checking, he is also checking the amount which is deductible. It is correct or not. He is also checking the refund if there is any, if it is correct or not. He is also checking the fee which is applicable under 234E. This is the amendment which has come. See, this section came in 2012. But this 234E, this one came in 2009, whereas this 234E came in 2012. How many of you are familiar with 234E? When you're doing the work, you must have seen. We know that people are not very prompt in filing TDS returns. To take care of them, these penalty sections have come, and this is one among them. 234E says we will pay 200 rupees for every day of delay. So this came in 2012, whereas this 200A, assessment of TDS returns, came in 2009. In this theory, this fee concept was missing. So now 200A is telling when assessment is going on, the officer can also do assessment with respect to the fee that is payable under 234E. That is the amendment. So what is one line? 200A is a section which is talking about assessment of TDS returns. When the officer is doing assessment, he is checking arithmetical errors, rates, incorrect claims, amount which is deductible, refund. In addition to that, he can also check the fee which is to be paid under 234E, and he will pass an order, intimation, and that order will be treated as demand notice. And if you don't pay with the demand notice within 30 days, you will be called SSC in default. And once we call you SSC in default, interest, penalty, 220, 221, all those sections will start on you. This is what you need to remember. So not a big amendment, just this one word got added. So ignore. Then what is this next one? 206 CB. Okay, this one is same as 200A. Same as 200A. Why? 200A is from TDS point of view. 206 CB is from TCS point of view. That's the only difference. Okay, 200A is TDS point of view, 206 CB is from TCS point of view. Everything is the same. What do you mean by same? The officer will do assessment of TCS returns. He will check for incorrect claims. He will check the amount payable. He will pass an order, interest, penalty, everything will be checked by him. The order has to be complied within 30 days, otherwise the person is called SSC in default. Interest, penalty will start. Same story here again. Okay. And everyone. Yeah. So now coming to other important areas. This is another potential question for exam. So if you're sleeping, get up. I know those who do your tax audit, you might be very comfortable with this, but there are some questions for us to analyze and learn. Let us see now. We are discussing amendment in 269 SS. Exam question we are leaking, we can say. So important it is for your exam. May attempt 269 SS. Okay. There is a person and there is another person. So this fellow receives in what mode? In cash. Receives in cash what? A loan, a deposit, or a specified sum. Okay, then we need to check the amount or the aggregate of amount. Together with yes, amount remaining unpaid. Some outstanding is still there, unpaid. Amount remaining unpaid is 20,000 or more. 20,000 or more. And this 20,000 or more has to be checked person wise. Okay, so now some of you are wondering what is the amendment which has come. You realized what is the amendment?
Outstanding.
No outstanding. Specified sum. Specified sum is the amendment. What is the specified sum? Exactly. Okay, so now between the two people there is a transaction for sale of immovable property. Sale of immovable property. And this immovable property can be either a capital asset or a stock in trade. We are not interested in which capacity you are selling the immovable property. Real estate transaction is happening. With respect to such real estate transaction, you receive specified sum. Can you guess now who is this fellow? If you are discussing, he is a transferor, the one who is selling. And if he is receiving a specified sum with respect to immovable property, what it could be? It could be an advance. We don't know when immovable property is into transactions, we take advance. Whether it is a construction company or a normal seller, they always take advance. Without advance, transactions don't happen. So some advance has been taken. And what is wrong with the advance? How is it taken? In cash. Okay, so see, earlier these sections were just addressing two things. Loan taken and loan repaid. But now this section is also watching our real estate transaction. So if you have a real estate transaction with respect to which you accept an advance in cash, this section is so dangerous. It is telling that if the size of the transaction is 20,000 or more, then in that case this entire amount is prohibited. This is actually a section which is prohibited. Prohibited transaction. When you do a prohibited transaction, what is the good news? You have a penalty. What is the penalty section for this? 271D. Okay, we will read. Yeah, what is that section telling? The entire amount of transaction becomes your penalty, whatever size of the transaction. So you did a transaction for 90 lakhs, the penalty is 90 lakhs. No 10%, no 20%. So dangerous that section is. So this is actually prohibition. So what is the prohibition saying? Any loan, any deposit, any specified sum. These two, loans and deposit, don't link it with immovable property. They are independent loan transaction. Specified sum is linked with immovable property. If you receive in cash amount or aggregate amount, single or multiple loans you have taken, together with the previous loans which are remaining unpaid, 20,000 or more, then person wise it is prohibited. Okay, so we will do some examples to understand. Before that we will write a note. What is that note? This section is not applicable. When does this section not apply? If transaction is with government or bank. If you are doing these transactions with government or bank, we should not say it is black money, it is mischief and all. We should not apply this section. Note number 2. Yes. If the person receiving the above and the person giving the above, person receiving the above and giving the above, both, not one, both, have agricultural income and no other taxable income, then section 269 SS is not applicable. So this money lending and taking a loan, giving a loan, this person and this person, who are they? They are people with agricultural background. So we know that in agriculture farmers are in need of money. They always take money, what more, in cash. So when farmers are taking a loan or deposit in cash, we cannot put 269 SS on them, because for them it is unavoidable. Cash transactions are unavoidable. Size of the transaction is not important. What is important is what kind of income they have. These people who are receiving and giving both have agricultural income and they have no other taxable income, then this section does not apply. So the size of the agricultural income could be 1 crore also. We are not worried about the amount. What is important? They should not have any other taxable income. Then this section will not apply on them. This is one important thing. Okay, this note number 3. Note number 3 already I have written here on the top. What is that? Specified sum means any sum of money or advance in relation to transfer of immovable property. Whether or not transfer takes place, immovable property could be capital asset or stock in trade. Okay, stock in trade. So now see, one word they have written, transaction may or may not take place. What do you mean by that? Sometimes negotiations fail. So even if negotiations are failing, if you had any transaction with respect to your immovable property, this section will apply on you. Okay, so what is the next section? 271D. Non-compliance, if you don't bother to comply with 269 SS, will result in a penalty which will be equal to the size of the loan, deposit or specified sum which is received by you in cash, and this penalty, the power to levy is levied by Joint Commissioner of Income Tax. Joint Commissioner of Income Tax. So whenever you don't comply with 269 SS, there's a penalty. Penalty is equal to the loan amount, the deposit amount or the specified sum which is received by you, and the penalty will be levied by Joint Commissioner of Income Tax. Okay, now see case 1 to understand this. One fellow received 19,000. What's the answer? 19,000 is less than 20. 269 SS will not apply. Case 2, example 2. One fellow received 20,000. See, all of us got used to learning anything more than 20. Now be careful, it is 20 or more. So exactly 20, this section will apply. Another case, one fellow received from Mr. A 15,000 in cash, from Mr. B 19,000 in cash. This section is telling from each person. We never said from all people put together did you receive more than 20. From each person did you receive more than 20. 15 is less than 20, 19 is less than 20. This section will not apply. Aggregate is not all people, it is person wise. Okay, next one. Case 4. We have taken 15,000, take it, in one particular month, then 15,000 repaid. And for every example, what is the underlying theme? It is in cash. Otherwise, we are not discussing this. It is in cash. We took 15, we repaid 15. This happened somewhere in April. It's a closed transaction. Now in May, once again 19,000 is taken. Now you should be very careful with the interpretation. See, they are saying how to find out the amount. They are saying this new loan, 19,000 plus amount which is outstanding, that is the theme. So in this case, when you have taken and you repaid, how much is outstanding? 0. So amount outstanding is 0, and this is only 19,000 which is less than 20. This section will not apply. So see, if you don't understand this interpretation, you will think aggregate of loans taken, just like how we do for TDS. You make contract payments to a contractor, 194C. What do? All the transactions put together during the year, is it more than 70,000? Then we put TDS on it. So you may apply that logic here. So we are saying, no, not that logic. What you need to check is amount outstanding, you have to see. So 19 is less than 20. Anything repaid and became 0, then this section will not work for you. See the next example. The next example says, there is one person, what he is doing, he is taking 15,000 on 1st Jan, he is taking 16,000 on 10th Jan. Okay, now what will happen? And nothing is repaid, all are outstanding. So sum up, it is more than 20. This section is attractive. Okay, next one. Next one, what happened? There is a transaction in immovable property. The size of the transaction is 100 lakhs. They are trying to confuse us. 10 lakhs is received as advance in cash and 90 lakhs is received in check. Okay, total size of the immovable property is 100 lakhs. Out of 100 lakhs, 10 is received in cash and 90 is received in check. Whether this section will apply? Yes. Answer is yes. To what extent it will apply? Yes. Only 10, not the entire transaction. Whatever you received in cash, that is prohibited. So you have received 10 lakhs in cash, this is prohibited. This section is putting penalty on you. This 90 lakhs which you received in check, there is no such prohibition. But if I change this and say, this is also cash, then entire 100 lakhs will become your penalty. You need to be careful. Okay, so we finished learning which one? 269 SS along with what? Penalty section. What is the penalty section? 271 D. Okay, see the next one now. The next one is 269 D. Tax audit, most of you will be reporting on this. So for you it is child's play. Right? But some firms, they don't allow you to do tax audit, they just make you do statutory audit. Some firms, they only make you do the tax work, they don't make you do the other work. So that problem is always there. So, but I did my articles from Anandam and Company. We were lucky to do everything. Anything comes to the firm, our sirs were very kind enough. They used to appreciate that every student should have an exposure in each and everything. So they ensured that we never did the same thing second time. That they were so kind. But actually human nature says they already did that, they know very well. Yeah. If we send them, they will do it again. Well, that is human nature. But for them, it is like this, you know, same people become overconfident and they may not do it well. If you send a new team, maybe they will come up with better audit report. So they were so kind. That's why I used to really miss my days at Anandam. Very nice people there. Learned so many good things from those people. Okay, let's come back now. 269T. This is a person which is including bank. So even bank we are addressing here. And what are they doing? They are doing repayment. They are repaying. Again, repayment in what mode? In cash. What? Loan, deposit or specified sum. If aggregate amount, aggregate of loan, deposit, specified sum with interest. Now you need to add interest and see if it is 20,000 or more, then this section will apply. So what we are checking, the person is making a repayment of loan, deposit or specified sum. And these sections are not mutually exclusive. So at one point of time, you have received in cash and you repaid in cash, you will suffer penalty twice based on the previous section and based on this section. This is not like 69D. If you remember in your IPCC you studied 169D. Loan taken on hundi by any mode other than check, cash loans on hundi. Yeah, that section was very kind. What did it say? If you were already taxed at the time of borrowing, once again you will not be taxed at the time of repayment. Only interest will be taxed over and above the principal. Double taxation we will not do. But these sections are telling when you repay in cash also we will trouble you. When you took it in cash that time also we will trouble you. They are not mutually exclusive. They are coming together. Okay. So once again, what is the note? What is the note saying? 269T is not applicable if transaction is with government or bank. If you are having transactions with government or bank, then this section will not apply. And another important note is for the amendment which has come. If person receiving advance for immovable property, either in his name, either in his own name, or jointly with any other person, if either he or with another person is 20,000 or more, 269T applies. 269T applies. Let's understand this with an example. What did I write? Aggregate amount of advance received. Okay, aggregate amount. Who's receiving it? By the person along with another person who's a joint owner. All this put together, if it is 20,000 or more, then this section will apply. So those who can't see, I'll repeat again for you. Aggregate amount of advance received along with the person who's a joint owner. If this aggregate is more than 20, then this section will apply. So what is this sad thing? Mr. A is planning to sell to Mr. B B his land and building and he got advance. Okay, but Mr. A and Mrs. A, both of them are joint owners. Joint owners. So what did Mr. B do? He gave two things. Here to this person he has given 18,000 in cash as advance and to this person 17,000 in cash he has given. So what did the note say now? What is the note telling? Whenever a person is a joint owner, then in total you have to check. You should not say 18 is less than 20, 17 is less than 20. Rather, it should be summed up. Two people, Mr. A and Mrs. A together, is it more than 20,000? But previous section when we were studying, we took loan from A, we took loan from B. We never did totaling up. But this is a different thing. What is this? It's a transaction in immovable property and there is an advance taken. So here we are saying you do the total and check. If the total of both is more than 20,000 or more, then this section will apply. So just give a glance, and once this section is over, what is the next to section? 271E. What is 271E? The above, if it does not apply, repayment, repaid, loan, deposit or specified sum will be treated as penalty under section 271E, and this is levied by whom? By the joint commissioner, Just come to your handout once just to appreciate whatever we learned so far, because I told you it is important. Page number 33. See on the top, Mr. A has received a loan of 1 lakh on 1st Jan from Mr. B by account payee check. Okay, receipt. We have to now answer from two angles, receipt as well as repayment. So receipt is account payee check, 269 SS will not apply. But Mr. A repays in cash. Yes, 269 T will apply. But now, yes, very good doubt. That's why this example has been picked up. See, all of you come to the theory. Person including a bank makes a repayment or to another person. So here now, the very interesting part is this 20,000 is not to be applied to the amount which is repaid. Rather, this 20,000 should be applied to the loan which was taken by you. So what is the loan amount that you have taken? You have taken a loan of 1 lakh and this 1 lakh is more than 20,000. And how you are repaying? You have repaid only 10,000. But even though what you repaid is not important. Here, this line that I have written here I am not saying how much is repaid. Here I am saying if aggregate of loan, deposit or specified sum with interest is 20,000 or more, this section will apply. So you need to look at the original size of the loan. How much you repaid is not important. But for the sake of penalty, see there are two different things. For the sake of section, you see the entire loan. But to put penalty under 271E, we are not putting entire loan as a penalty. How much is penalty now? 271. Yes, how much you paid in cash, that is your penalty. But to see big or small, the entire loan has to be checked. Be careful with this interpretation. So in this case, the loan is 1 lakh, therefore it is 20,000 or more. This section will apply, but penalty is only 10,000 because you have paid in cash 10,000. Why the fans are off here? What happened? No water? Everybody is, no need of fan. Oh, you can switch it on if you want. Let's see the next one. You'll feel sleepy, a fan, very good. Mr. A agrees to sell his property to Mr. B and receives 10 lakhs in cash as advance money on 1st June. Advance received 1st June. What did we say? Receipt, which section? 269 SS. The sale agreement is cancelled and Mr. A refunds. Refund is repayment of advance received. 269T will also apply. So therefore penalty becomes 20 lakhs. Okay, repayment of advance is nothing but negotiation is cancelled, and if you do a refund, then in that case this section will apply. So what is the message that we got here? Stop taking cash. Start cultivating which habit? Banking habit. That is the message that we got. That's why the sections are so harsh. Why are you feeling bad for people? Now see the last one. A house property is registered in the name of Mr. A and Mrs. A jointly. Both agree to sell the property to Mr. B on 1st Jan and receives advance of 15,000 each in cash. Now agreement to sell is cancelled and they are refunding 15,000 by cash and 15,000 by check. So what is penalty is different. First of all, is the section applicable? Answer is yes, because sometime back we learned the limit is to be checked under joint ownership concept, 2 people. Now coming to penalty, see the answer. Okay, so both agree to sell the property to Mr. B on 1st Jan and receives advance of 15,000 each in cash. See the question, answer here 269 SS is not attractive. The reason being, the note which we have written here, okay, this note is not there for 269 SS. See, concentrate now. When it comes to 269 SS, there was a no note which was talking about for 20,000, look at joint people and check the amount. This note is missing here. So for this note, when it is missing here, then you need to check 15,000 each person. And 15,000 each person is less than 20, so 269 SS is not attractive. But when it comes to refund, that time we are saying there is a note applicable which says that you have to do the aggregate of both the joint owners and then check. So see the answer now. However, section 269T is attractive since the aggregate advance received by Mr. A jointly with Mrs. A exceeds 20,000. Since Mr. A has paid 15,000 in cash, he shall have to pay a penalty of 15,000. Okay, see, end of the day, the message was that this section you may ignore because you are busy studying the main chapters. Because there is an amendment, there is a possibility of getting a question. Go back to your standard book, spend some 10 minutes, read it carefully and become confident in this area. Another potential exam question, 271 1C. It is always a favorite question of the examiner because some amendment or the other comes, some litigation or the other comes. So we suggest you should study not less than 1 hour on this section alone. This amendment is small, we will finish it in some time, but the other side, the whole story about this section is so important that it requires at least 1 hour of yours. Penalties chapter is very important. 4 amendments have come. Again, good news, you may get a straight question from there. Okay, DT better to write in May only here. No? DT is always better in May? No? Yeah, November is bad for DT. May is the best. Because at least you can guess what can come in the exam. See, so many penalties are there. How many of us will remember? Very difficult. But at least if you can master those 4 new penalties which have come, then I think we can help ourselves. So let us see the new penalty which has come. So we are discussing 271, which is a penalty for concealment of income. Penalty for concealment of income. Okay, penalty is on 100% to 300%, it will vary, but it is on tax which is sought to be evaded. Tax is sought to be evaded. What is the size of the tax which is sought to be evaded? And the formula for this is tax on income including concealed income minus tax on income excluding concealed income. This is the formula. Tax is sought to be evaded. Tax on income including concealed income minus tax on income excluding the concealed income. Okay. And this is in a simple language, but if you actually refer to the section, it is using the word assessed income. Okay, assessed income. Under general provisions of IT Act. IT Act, that is the language. So what is the tax on the assessed income? Assessed income includes concealed income. Some amount you have hidden, you have done some kind of tax evasion, you have inflated the expenditure, or you have not shown your income totally, some concealed income. That is called your assessed income. Tax on income including concealed income under the general provisions of IT Act. But if this is the formula, see what is the blunder in this formula? What is the blunder in this formula? Point number 1. Blunder number 1, it says, okay, the SSC, regular income tax is less, he is paying tax under MAT. Okay, then the concealment had an impact here. The concealment had an impact on assessed income under general provisions of the Act. But we are dropping this regular income tax and we are taking MAT from him. When we are taking MAT from him, the question was whether the penalty under 271(1)(c) is needed. So most of the judicial rulings were saying no, it is not needed because we are going with MAT. This is what the court said. But do you agree with this? Why? What is wrong with this? Okay, as of now you are picking up MAT, but along with MAT you are also calculating MAT credit. How do you calculate MAT credit? How do you calculate MAT credit? What is the MAT liability that you are paying minus what is your regular income tax? So whether this regular income tax has an impact because of concealment? Yes. Then your MAT credit is going wrong. So this is one area. So what we were saying that this original formula does not take care of a situation where a person is paying tax under MAT. That is one issue. And many courts were holding that no penalty is required if concealment of income is under general provisions but tax is paid under MAT. Understatement of income and tax liability under general provisions leads to larger MAT credit. This is the situation. Okay, so now what did we realize? Earlier the formula was like this. This formula was not taking care of situations where people were paying tax under MAT and it was having an impact on MAT credit. So they have changed the formula. They have come up with a new formula. Now what is this new formula? Let us understand. Very simple it is. The new formula is saying amount of tax which is evaded is equal to A minus B plus C minus D. Okay, now what is this? You can guess. This is calculated under general provisions and this is calculated under MAT provisions. Okay, now students will get a doubt, but we know that a person will pay tax, regular income tax or MAT, whichever is higher. Then you might be wondering that how can we act like this? Okay, for this also there is a justification. Please write down. This is an exam question here, no sitting idle. You should be writing. And we will solve an example also to understand this. So general provision. So write here, tax sought to be evaded. Sought to be evaded under general provisions, and here we will write tax is sought to be evaded under MAT provisions. Sought to be evaded under MAT, and here we are writing under general provisions. Okay, now write a note to understand that sum. Okay, so write down. In the above case, if amount of concealment on any issue, is common, for regular income tax, and for MAT, regular tax and for MAT, then it shall not be considered, for C minus D. But the next point, but if the amount of concealment is on different issues, it will be considered for A minus B, C minus D. Okay, what is this point telling you? Just pay attention. See, A minus B is from your regular income tax purpose, whereas C minus D, let's say we were supposed to do those adjustments in MAT, where you're adding and you're subtracting. In those additions and subtractions, you did some concealment of income, the amount transferred to reserves or some kind of provision. There you have done some mischief. So in your MAT computations also you're doing some mischief, and in your regular income tax also you're doing mischief. You're not supposed to do mischief. So how we will trouble you? Mischief done here, both put together, we will take penalty from you. But actual ITL is whichever is higher. But when it comes to taking penalty from you, we are discouraging you from concealment. You should not conceal here, you should not conceal here. If you conceal, same issues are coming both the places, then we will not take it twice, we will take only here. No, the issue which is concealed is different. Here it is some other item and here it is some other item, then both we will not take from you. That is what they are saying. And last point, if provisions of MAT are not applicable, C minus D shall be ignored. If provisions of MAT are not applicable, C minus D shall be ignored. C minus D shall be ignored. Okay, this example is worth doing here. Let us do. Write down example, not in the handout. That handout is for you. Keep it, you do the example. It is self-explanatory. There is something else which is important. So let us say the total income, just to appreciate the concept that we learned, total income as per general provisions of the Act is 80 lakhs. It is a company, and if you compute, surcharge is not applicable because it is not more than 100 lakhs. ITL is going to come to 24 lakhs 72,000. And for the same company, the book profits are coming to 2 crores, 200 lakhs. And when you compute MAT under 115 JB, it is coming to 40 lakhs 77,770. Okay, so MAT is 18.5 plus surcharge. Why surcharge? Because the income is more than 100 lakhs. Just be careful. Now what happened? There is concealment of income. And now the normal income, the total income is now 110 lakhs as per normal provisions. Now if you compute ITL, tax on 110 lakhs now will become 36 lakhs 36,930. Okay, calculations you can do later on. Then we will write there is no change in book profits. Whatever concealment was there, that had an impact only on the regular income, but there is no change in book profits. Write the details. Finish writing? Everyone? You have a handout with you? Okay. Write the answer now. Please write. This is the details about concealment. Now we will write what is the implication prior to budget and after budget. Prior to amendment, There is no penalty. How come? Why no penalty? How did they pay tax? Which tax they have paid? Even though you compute, it is only 36, but how much is MAT? 40. So we just learned in the beginning that earlier wherever tax was paid under MAT, even though there was concealment of income, they never took any penalty from us. Who was telling us this? The court rulings were telling us that anyways MAT is paid, then why do we give importance to concealment of income? But that is cultivating a bad habit among people. You should not do that. So therefore they have amended. So right there, prior to amendment, no penalty for concealment. Prior to amendment, there is no penalty for concealment. As the SSC paid MAT, as the SSC paid MAT. This next line, it would affect the MAT credit. It would affect the MAT credit. Okay, so yes, how it would affect the MAT credit? Imagine if this concealment was not notified, not noticed, what people would do? They would have taken MAT credit 40 lakhs minus ITL 24. But now MAT credit is 40 lakhs minus ITL 36. So MAT credit will have an impact. Next slide. As per the amendment, the amount of tax sought to be evaded, shall be computed. Amount of tax sought to be evaded shall be computed as follows. A plus B minus C minus, right, A plus B, sorry, A minus B, yeah, A minus B plus C minus D. In this problem, C minus D is nil. Why it is nil? The concealment had no impact on book profits. Therefore, it is nil. Only difference is on A minus B. What is A? What is the ITL which is including the amount concealed? 36, 36, 930. Minus, without this concealment of income, what is the ITL? 24,72,000. The difference between the two will be treated as your tax sought to be evaded. How much it is? 1164,930. Okay, 1164,930. So next line you can write. AO can levy penalty of 100% to 300% based on the kind of concealment and mischief they did. It varies from 100 to 300. 100% to 300% of 11,64,930. Okay, so now you understood that for writing purpose, even though there is plus C minus D, this will not have a huge impact. There could be a case like this also. But the example which we have given for you, just observe. See what is this example? Same thing, simple version. In this example also, the tax payable as per assessment order, amount of concealed income as per assessment order. So concealment is not having any impact on MAT, because of which C minus D is becoming nil and people are paying tax only. This penalties sought to be evaded as per A minus B. So whether this example or that example, the purpose is the same. Just go through that once. So what is the conclusion? Under tax is sought to be evaded, what new concept has come? They have introduced MAT provisions also. So they are saying the C minus D will take care of concealment under MAT. However, if the item is common here and here, don't put it twice, don't trouble the SSC, put it only once. But if the item is different here and item is different here, then both you consider and take penalty from him. He is not supposed to conceal even here as well as here. Okay. Coming to the next one, what are the other penalties? It will just take 5 minutes and we'll be done. Okay, some new penalties have come. New sections which were not there earlier. What are these 3 new sections which have come? 271 FAB, FAB, 271 GA and 271 I. Eligible investment fund referred under section 9A. Next one, Indian concern referred under section 9. And last one, any deductor which is referred under section 195 subsection 6. Okay, just pay attention what we are discussing. Yesterday I was telling you that eligible investment fund. What is this? Non-residents, foreign institutional investors, offshore funds, they are also depending upon some mutual fund concept. These funds were earlier located outside India, but the investment was becoming difficult for them. So we said, even if you come to India, we will not say it is a case of business connection, we will not trouble you, we will not make you resident. But one formality we are expecting from them. What is that? You people give us a statement. See, one statement you give, we want to know what kind of activity you are doing, what is that you are doing. Based on that statement, we can trust you. But if you fail to give that statement, then we will put penalty on you. If there is a failure to give statement, we will put penalty from you, which is 5 lakhs. Okay, when we are giving you some concessions, we expect you to report to us. If you don't report, then we put penalty of 5 lakhs. Coming to the next one. The other day we were discussing from Hutch example, Hutch India. Okay, what was this Hutch India? It was an Indian concern. Because of its assets, the foreign company shares were earning value. So we are telling to this Indian concern, whenever you have a transaction which will change the management or control or ownership, directly or indirectly, some people are buying and selling your shares, your control, your management is shifting in the hands of some other person, you have a responsibility, please inform us. Okay, you hide and do the transactions in crores and crores of money, and later on litigation will start not good. So Hutch India, whenever there is a transaction which results in change in management or control, please inform us. Okay, so this example I am saying Hutch India, but it could be any other company in India. Okay, so if you do not inform, then we will take penalty from you, which is 2% of the transaction value. 2% of the transaction value. Okay, and then we are saying in any other case, you have other cases also other than this, then we will take 5 lakhs from you. Basically, you have to report. Under this section also, we are putting reporting obligation on the SSC, and this reporting obligation, if you go, refer to 85A, go to the last page of your handout, last sheet. 285A. Last sheet, yes. Furnishing of information by an Indian concern in certain cases where any share or interest in a company or entity registered or incorporated outside India derives directly or indirectly its value substantially from the assets located in India. And all this reference we are giving to section 9. Then such company holds such assets in India through or in an Indian concern, then such Indian concern, okay, whatever it is here, that Hutch India should inform the department that some transactions are taking place which will affect in change in management and control. Reporting obligation is there. If you don't comply with the reporting obligation, penalties are attracted under this section at the rate of 5 lakhs. Okay, then next one, deductor 195.6. We are supposed to deduct TDS under 195 to whom? To non-resident. Okay. See, now when we are deducting TDS, sometimes TDS is there, sometimes TDS is not there. Do you agree? The income might be exempt by way of double taxation, avoidance agreement, or it may not be an Indian income. We are saying to these people, to the deductor, whether TDS is attracted or not attracted. Whenever you give any money covered under 195, please inform us, report to us, because non-residents are involved. Obviously the size of transactions will be big. We want to watch carefully such transactions, so there is a reporting obligation on you. So normally we don't do reporting. What do? We deduct TDS, we submit quarterly return. That is what we do. But in addition to deducting TDS and quarterly returns, separate reporting requirement we have put under section 195 subsection 6, whether it is chargeable to tax or not chargeable to tax, you have to report to us. And if you don't report, 1 lakh penalty we will take, 1 lakh penalty. So 3 new sections have come. Simple they are. So actually speaking, how many penalties we finished? Relating to 269 SS and T, D and E. These 3, 5. And 271 1C, 6. 6 sections we have finished. Right. Then there are a lot of amendments in other theories also. Indeed, here and there at random we will pick up and finish discussing. Okay. What is the next one? 263. Penalties are done here at random. I said, oh, we'll just finish off. 263. What is this 263? Commissioner of Income Tax has got power. What power? To revise. Power to revise the order. What order? Point number 1. Order is passed by the assessing officer. Point number 2. Such order is erroneous. Point number 3. Such order is prejudicial to the interest of the revenue. Prejudicial to the interest of revenue. If these 3 points are satisfied, then we can do revision under 263. So now clarification has come. Okay, this amendment is a clarification. What is this clarification? What do you mean by erroneous and prejudicial? This clarification has come. Earlier, lot of litigation was there, so we used to refer to the court rulings and understand whether it is erroneous, prejudicial. Now they are telling us, if the following points are satisfied, such order will be treated as erroneous and prejudicial. See, understanding these topics is possible only when the regular theory is done. So we haven't done. To my students I am saying, these topics we didn't do, but we are just learning it for the sake of others. When we come back to this chapter, that time we will repeat again. Okay, others are done with the revision and all? Revisions, appeals. 10 o'clock we'll take a break, yeah? Don't go to sleep. Okay, by 10 ho gaya? 9:90. More 10 minutes to go. We'll finish off 2 things. Okay, when is it prejudicial? Point number 1. Order is passed without making inquiry. You are supposed to do proper inquiry. You are not doing any inquiry. You are simply passing an order. Okay, because of which the income is not correctly calculated. The ITL is not correctly calculated. Inquiry is needed. Calling documents is needed. Books of accounts you should call. Without inquiry, you are simply passing an order which may result in a small income and small ITL. Or the next one is without any inquiry, you are giving some claim. Allowed is some claim. The SSC is claiming something. The claim could be with respect to deductions. The claim could be with respect to exemptions, tax holiday or section 35 or 3580. Some kind of special claim you have entertained even without finding out whether it is correct or not, without inquiry. Or the next one, not in accordance, the order which you have passed is not in accordance with the guidelines given by CBDT. See, whatever CBDT circulars have come, those are binding. You have to do it according to that, and you are not doing it. And it is not in accordance with High Court and Supreme Court judgment. High Court judgment and Supreme Court judgment. On the same issue, some judgment is there and you are not applying that judgment. Without applying the judgment, you have simply passed an order. Such order will be called as erroneous and prejudicial. So now you may get a small theory question here. What do you mean by erroneous and prejudicial in the context of 263? So you need to remember 4 points. Without inquiry, you are passing an order. You are not inquiring about the claim. You are not referring to the provisions of CBDT, or you are not referring to the judgments of High Court and Supreme Court. In all such cases, it will be called erroneous and prejudicial. Okay, and one last thing. The next one we are discussing is from, again this topic also better understood if you have done appeals. Avoidance of repetitive appeals. Repetitive appeals. So statistics is telling almost 10,000 appeals are pending with Supreme Court it seems. And more than a lakh is pending with Income Tax Appellate Tribunal. That is the size of outstanding litigation. Huge cost is involved. So imagine every time people are going for appeal, it is not good. So how to avoid repetitive appeal? You can guess what could be the story. Same company, same issue is pending somewhere. The same issue, once again if you are going in appeal, it is waste of time. So what should be the alternative? Let us wait, let them pass an order, whatever judgment comes, that we can apply for these years. So for an earlier year, some question of law is pending with Supreme Court, High Court. Then with respect to such question of law, once again going for an appeal is not correct. Rather, let us wait what they will say and accordingly apply. That is called procedure for avoidance of repetitive appeals. So in this, they had one older section 158A. Now they came up with a new section 158AA. Okay, 158A is a procedure. It is talking about the procedure when SSC claims identical question of law, SSC claims identical question of law is pending for an earlier year. Identical question of law is pending for earlier year before High Court or Supreme Court. Identical question of law. Whereas in this case, it is talking about procedure when revenue, that means the commissioner of income tax, revenue claims identical question of law is pending with Supreme Court or High Court. See, I will not discuss the procedure, I am only giving you the logic, what has come. You can read the procedure because procedure understanding is possible only after completion of appeals. What is the procedure? Then you will make an application. Instead of going for an appeal, you will apply. What is that application? You are saying that for this SSC, earlier year, this question of law, so-and-so interpretation, deduction or exemption is pending with High Court. So once they decide, we will apply that case here. Like that, you will make an application and you're waiting. So that is what is the procedure. So you need to read the procedure. What's the difference between the two? What is the difference? In this case, who's making an application? SSC. In this case, who's making an application? The department itself, saying that no, let us wait for the judgment to come. So some 4 to 5 steps are there, procedures are there, just go through that. Okay, so take a short break. How many minutes do you want? 10 minutes are enough. Okay, what are we going to read? See, Settlement Commission has undergone plan of action after the break. You should know what you're studying. After the break, we will be studying Settlement Commission. Some amendments have happened. 234B, how to compute interest, start date, end date, they have changed in 2 cases. And that's it. Then we have to do that business trust and ICDS. So those who are done with ICDS can leave us. Okay, I don't mind because I respect your time. Your time is very important. I already know ICDS, you can go. Those who do not know can stay back. Okay, so after the break we will do Settlement Commission. So you can stay back for Settlement Commission or you can leave. Or do you want me to finish off Settlement Commission now? Then you will leave. That's better? Which one? MAT related. But that requires business trust. You people don't know already business trust. I will explain it to you later. Why do you waste your time? So shall we finish off Settlement Commission and then take a break? What do you say? How many of you all are planning to stay back for ICDS? Because we already did for you, no? Okay, once again. Revision. Okay, others will be leaving after Settlement Commission. Okay, then we finish off Settlement Commission 10 minutes. No, I was seeing your body language. Some of you were getting restless, so I thought maybe they are hungry. So I thought break is from 7:30 you're sitting.
Ma'am, we can say after
No, Shivratri, anyways they are not eating, it seems. I know you are preparing hard for your results, for your exams. Be positive. I'm sure you all are working your best. So let's be positive. What we believe we get, it seems. If you think you will get, you will get. So be positive as much as possible. There's no other option, no? Yeah. So now what are the amendments in 234B? See, once again, it is not possible to solve a practical problem and finish because 234B concept itself has to be understood. It takes time. So because you already heard about 234B, we will run through it. What is that you know about 234B? This is a section which is talking about interest when there is non-compliance with advanced tax. Advanced tax provisions you have not complied, so you need to pay interest under 234B. So there are two cases where they have come up with an amendment. Case 1. Case 1 is talking about, it is a case where total income, the person's total income is increased. Why is it increased? Due to assessment or reassessment. Reassessment under section 147 or 153A. So 147 income escaping assessment, 153A search and seizure. So because of these reasons the income has increased. Then in that case, prior to amendment and post amendment, what is the difference? What is the start date for calculating interest? The start date is the date after regular assessment under section 143 subsection 1, whereas now it is first day of A1 from the assessment year. What is the end date? No change in end date up to the date of assessment, reassessment, up to the date of reassessment under section 147 or 153A, and this is same law. Okay, see now, all of you pay attention. What happened here? Earlier we were saying whenever the regular assessment was done under 143(1), see now basically what happened, one person has filed his return. When he is filing a return, you get the summary assessment. Summary assessment is just an intimation that the return has been accepted, a kind of acknowledgement. The computer does the summary assessment. So whenever you got that order of summary assessment, so let's say a person has filed his return in the month of July and he got the summary assessment intimation somewhere in the month of October, November, December. Refund orders are very quick. They do it even before the AY is getting over. So once you get that order and later on your case has been picked up due to some information for income escaping assessment or 153A, because of which income has been increased. So that time when we want to compute 234B, obviously this entire big income tax should have been paid under what route? Advanced tax route. And if you have not paid, obviously interest is attracted. But from which date is attracted? So we were doing a blunder. What was that blunder? When was this original regular assessment passed? Somewhere in October, November. From that day, we were calculating the interest under 234B. So this assessment, this amendment is telling the liability is right from the first day. So therefore it should be calculated from first day of AY. The liability is not starting from this day. See, the reason is this total income should suffer ITL. ITL should have been paid by advanced tax route. Whenever you're not complying with advanced tax rules, from first day of AY, the interest will start. So now the issue is, just because you were under regular assessment, what about the period prior to regular assessment? Where will that go for interest? So they amended and said, no, not regular assessment. Right from first day of the AY, this section is attracted. This is the amendment. Okay, what about end date up to the date of order? Then you will get a doubt here. What about date of payment? This is the date of order. Interest should be attracted up to the date of payment. No, the answer is, once this order is passed, within how many days you should be paying? Within 30 days. And when you don't pay, you're called what? SSC in default. And once you're called SSC in default, from that day, again new interest will start from 220, 221. That will take care of you. But as of now, this interest is from first day of AY up to the date of order. So earlier we were starting from date of regular assessment. Now you forget regular assessment, start from the first day of AY first day. This is one case. Second case in 234B. So just be careful. And once again, 234B are potential questions from exam point of view. I don't know how you have studied, but you should be knowing. CA final students, I know you depend upon calculators. Okay, on internet, you have software utility tools where they calculate for us 234B and C. But don't do that. You do it in your client's place. But for your exam, calculator, the software will not work. You have to calculate yourself. So please learn. Okay, but for my students, we haven't done the last module. We'll be doing it this week. For them, all these topics are pending. But I wanted to finish off the amendment class because most of you were planning to do group 2 studies from this month. So once you know the amendments, you will know which area to concentrate, how to concentrate and proceed. So that's why this class. In fact, it is late. Other faculties have finished last month itself, no? Yeah. Chalo, no problem. Next one, 234B. Late is also good, no? Some leftover students like you can come. Okay, next one. Next case is where application is filed for settlement commission. Okay, once again, you know this is one more route. Just like how we have, we know that for big cases, litigation is pending in the various authorities. If you further postpone the litigation there, it will result in revenue damage, time, energy is wasted. So government started the settlement commission topic where people are allowed to make an application and all their pending cases will be resolved here. It is a speedy mechanism to settle your cases. So here you have submitted. So what happened here? Prior to amendment, see, we should be wondering why they realized so late. Actually, these amendments are not something very new. They should have realized long back, but they are realizing now. This indicates that you should become very hungry. Tomorrow you should become a lawmaker and identify, read the entire law, see what are the amendments that are to be done and finish them. Every year troubling the students is not good, right? Based on economy, things are changing. Coming up with an amendment is different thing. But these, nothing to do with the economy, nothing to do with the new topics, but still so many loopholes. So prior to amendment, the start date was 1st April of AY. And end date is up to the date of application. But after amendment, it is 1st April only of AY, and here it is up to the date of order. See, now what is the case that we are discussing? Application is filed for settlement commission. So some dispute is pending for which we have gone to settlement commission. Interest is to be paid under 234B. So from what period are we going to pay this interest? So we are saying earlier it was from April to the date of application, but now it is from April up to the date of order. Will it make sense? Answer is yes. Because once you apply, they are not passing the order immediately. They have time. So when they have time to pass the order, what about the interest which is due on the advance tax which has to be paid? So how can you say up to the date of application? Obviously it should be up to the date of order, and once this order is passed, within 30 days you are supposed to pay. So interest will not stop on application, rather it should should continue up to the date of order. So that is the amendment. So there are no practical questions, we will not waste our time on that. Coming to the other theory on settlement commission. They done finished copying. 3 points got added in settlement commission. So let us see what are the amendments for settlement commission. Again, I am sure you will concentrate on this area. Theory is expected, settlement commission. Point number 1, settlement commission is giving us a list of which cases you can refer it to the authority under settlement commission. Point number 2, rectification order, rectification of order, amendment here. What is the time period? They have come up with some extension for us. Point number 3, how to exercise the power of grant of immunity, and point number 4 means amendment number 4 is abatement, and another amendment is point number 5, which is bar on subsequent application, So in settlement commission, 5 amendments have come. Amendment number 1. Okay, the theory is saying that only those AYs for which notice has been issued, under section 148, you can go for settlement commission. So what they are saying prior to amendment, with which respect assessment is pending with the authorities. When can you go to settlement commission? Only when they have given you a notice under 148. This 148 is a notice for income escaping assessment under 147. If notice has not been given, you cannot go to settlement commission. So now the amendment says assessment is pending for various years. Assessment is pending. You have filed a return of income. As of now, the department is busy handling one of the AY, 13-14. They have given you notice and they are taking care of 13-14. The previous years, as of now, they have not given any notice to you. But they have power to give notice. They have time also to give notice. So now this case is pending, and with respect to this, notice has come. So you are very sure that when they start digging your case for this year, automatically they will go back to these years also. But you are not able to apply to settlement commission because you are waiting for the notice. Now the amendment says no need to wait for the notice. Once you have filed the return and once the assessment is pending, even without getting a notice, you can still make an application to settlement commission. We will look into the entire block period, this year as well as previous years, everything we will look into it. So only one amendment now. What was the position prior to amendment? When can you refer to settlement commission? Only when notice had come from the department. After amendment, what we are saying, no need of notice. Even if the assessment is pending, the return of income has been filed, then in that case you can apply to settlement commission. That is the amendment. Okay, now rectification of order. Okay, if you want, just write one line for this amendment number 1. SSC can approach the settlement commission. SSC can approach the settlement commission for the other AYs. Even if notice under section 148 is not issued. Notice under section 148 is not issued. However, return of income should have been furnished. Amendment number 2, you write. Amendment number 2. Section 245 capital D. Settlement Commission related second amendment. Section 245 capital D. Rectification of mistake. Rectification of mistake apparent from record. Rectification of mistake apparent from record. Okay, what is this? The Settlement Commission has passed an order, but in the order they have made a mistake. And it is reflected on the face of the records. So now they want to rectify, because the order passed is not full and final. You can always rectify if there is a mistake apparent from record. So when they want to rectify, when can they do it? There's a time limit called within 6 months. Suo-moto, you yourself can realize the mistake and rectify within 6 months, or the commissioner can make an application saying that you made a mistake, then you can rectify within 6 months. So this concept of 6 months, one slight modification has come. So right now, Settlement Commission may rectify any mistake. Settlement Commission may rectify any mistake apparent from record, and amend the order passed by it. Amend the order passed by it. Small a. Suo-moto, they themselves. Suo-moto within 6 months, from the end of the month, in which order was passed. Small b. Any time within 6 months, from the end of the month, in which application for rectification is made by the commissioner or the SSE. Application for rectification is made by the commissioner or the SSE. In brackets you write, no application for rectification, shall be made by the commissioner or the SSE, after 6 months, from the end of the month, in which order is passed by Settlement Commission. End of the month in which order is passed by Settlement Commission. Okay. Just do this with an example. See, Settlement Commission passed an order on 1st December 2015. So if you go by small a, suo-moto, when can they rectify? Simple it is. We said within 30 days. Okay, sorry, within 6 months. So from 1st December if you compute, now be careful, how do we compute? See the language, what did we write? CO photo within 6 months. From when? From the end of the month in which order was passed. So you should see end of the month. So forget December, start from Jan. So in that case, you can pass order by 30 June. Be careful with this. You may get one question here. Alternatively, if the SSC or the commissioner is making an application, when they should apply for rectification, they should also apply within 6 months. So this application should be on or before 30 June. And once this application has been made within 6 months, rectification should be done within 6 months from the date of application. Then in that case, okay, let us say this application is made, application is made on 10th May 2016. Then leave this month of May. Within 6 months you should rectify. Then rectification should be done by 30 November 2016. Okay. So see, when you want to do it immediately within 6 months. When somebody is applying, they should apply within 6 months, and once they apply, from the month in which they have applied, end of that you have plus 6 months. So by 30 November you can do rectification. So just be careful with this. Now this second part was not there. So you're wondering where is the amendment. This second part was not there earlier. Okay, this extended 6 months concept. It was 6 and 6. Now they are saying let them apply within 6 months and you can rectify within 6 months. And now here what are we going to say? We will now come back to this point. What point is this? Power of grant of immunity. What is this immunity here? Settlement Commission, have you finished studying? Settlement Commission has got some powers. They can give immunity from penalty and prosecution. So this immunity, that means the person who has made an application for Settlement Commission will not suffer penalty and prosecution based on how he is complying, his behavior, he's nice in giving information, he's not hiding anything. Then penalty and prosecution is not there for him. This power is with the authority. Whenever they are giving power, this one line got added which says record the reasons. Why you're giving this relaxation for them? Why you're not putting penalty and prosecution on them? Please tell us, record the reasons. That is the amendment. Okay, that is not a big deal. Next one. Now, there is another topic called abatement. Abatement indicates the order of the Settlement Commission will not have any validity till die. Now, when is that possible? Okay, whenever the application is rejected or application is invalid or order is not passed within 18 months. So let us see now. All of you just write abatement, amendment with respect to abatement. 5 minutes will be done. Abatement of proceeding. It will not get carried over. It will lapse now. Okay, when? Point number 1. The application made to the Settlement Commission is rejected. Okay, because the person is trying to do some mischief. It is not a genuine case. He is trying to do some fraud. We are rejecting him. Or application is invalid. The reason is whenever they apply, we refer the case to CID for asking objections. And CID will come up with its own objections. And then that time Settlement Commission will not entertain. And third one, whenever order is not passed, they have time only up to 18 months. Whenever order is not passed within 18 months, it stands abated. Now fourth one got added. This was old and now a new has come. Okay, the new one says order passed not providing. Order is passed, but it is not providing for reasons. Settlement Commission is supposed to record the reasons why they have handled that litigation in that manner. So without giving the reasons and the terms, it should be a speaking order. You are silent about reasons and terms and you simply pass a vague order. If you pass a vague order, the proceeding stands abated. And one last thing here. Finished now? This one? Bar on subsequent application. Next heading you put 245K. Bar on subsequent application. Okay, those who finish settlement commission, you might be knowing that how many times you can apply to settlement commission? Once, only once. Okay. Now what happened? What people were doing? Okay, individual, he applied, and later on, this individual's company is applying, this individual's partnership firm is applying, this individual's HUF is applying. So he applied, we gave him settlement commission ruling. Later on, his concerns are applying. Can we give them? Answer is no. If you have more than, how much voting power? 50%, yeah, not 20%. They are saying in this company you have more than 50% voting power. In this partnership firm you are holding more than 50% share of profits. Or you are a karta in HUF, then it is as good as you are there here. So already you have enjoyed the settlement commission. Once again you do not come under the guise of this. This is the new thing that has come. So write down. Next amendment, the last one. Bar on subsequent application. Bar on subsequent application. Any person related to, any person related to the person who has already approached, any person related to the person who has already approached, also cannot approach the settlement commission. Cannot approach the settlement commission. So if individual has already approached company, partnership firm, AOP, BOI, okay, and then HUF. But what kind of company? The individual has more than 50% voting power. What kind of concern? More than 50% share of profits. What kind of HUF? Individual is a karta. Then in that case, you cannot come, they cannot come once again. But if it is a company, then for the company, any individual who holds more than 50% voting power. Already company went to settlement commission, then individual cannot go, the one who's got more than 50%. If it is a firm, then any individual who's got more than 50% profits should not go. If it is a HUF, then any karta of the HUF should not go. So this new topic came now. This list has come now. Okay, bar on subsequent application. Okay.